Okay, let's talk about the cash you have sitting in your bank account. It feels safe, right? Secure. But what if I told you it's silently losing its power every single day? In this explainer, we're going to pull back the curtain on this hidden risk and, more importantly, show you the super simple way to stop it and make sure your money is actually working for you.
So let's just ask it straight up. Is your cash really safe in the bank? I mean, you work hard for it, you put it away, you assume it's protected, and yeah, from someone stealing it, it is. But is it safe from just becoming worth less? The answer? Well, it might surprise you.
Here's the blunt truth. Any cash that's just sitting there, not earning any real interest, is slowly evaporating. Every single day, it can buy you a little bit less than it could the day before. Think of it like a slow, invisible leak in your financial bucket.
So why is this even a problem? I get it. It seems totally backward. Keeping cash in a bank should be the safest thing you can do, but letting your money just sit there in a standard account, well, it's not a neutral choice. It's a decision that is actively costing you money.
And we're not talking about a few bucks here and there. Financial experts are pretty clear on this. For a chunk of cash like, say, $50,000, the losses over time can be absolutely huge. Now, to be clear, the bank isn't just taking your money. The economy itself is shrinking what that money can do.
So what is this invisible thief? It all comes down to one word: inflation. You know, it's the reason a gallon of milk or a cup of coffee costs way more today than it did a few years back. And that exact same force is working on every single dollar you have saved.
Just look at this number for a second. Negative $7,000. Let that really sink in. That is a shocking amount of value just gone. What could you do with an extra $7,000? A vacation, a home repair? That's what's really at stake.
So where in the world does a number like that come from? Well, it's pretty simple math, actually. If you have $50,000 sitting in an account and inflation is just a pretty normal 3% a year, in 5 years, that money can only buy what about $43,000 can buy today. You didn't spend a dime, but you've effectively lost $7,000. It's gone.
Okay, so that's the bad news. It's a little scary, I know. But the good news, the solution is surprisingly easy. For real. It's all about moving your cash from a place where it's basically asleep to a place where it can wake up and actually start working for you.
And you've got some great options here. For your long-term goals, you've got investments. For returns you can count on, there are things like CD ladders. But for your emergency fund, or for savings goals that are just a few years away, the absolute sweet spot for most of us is the high-yield savings account, or, as you'll see it, an HYSA.
So what is a high-yield savings account? It's exactly what it sounds like. It's a savings account, it's fully insured by the government, just like your current one, but it pays a much, much higher interest rate. We're talking a rate that can actually fight back against inflation and often even beat it.
To really see the difference this makes in the real world, let's just use a super simple example. Let's say you've managed to save up $10,000. Awesome. Now let's see what happens to it after just 1 year in a regular old savings account versus a high-yield one.
And boom, here it is. This is the whole story right here. In your traditional savings account, that $10,000 earns you maybe $1. $1. In a high-yield account earning a pretty standard 4%, you'd make $400. It's the exact same money for the exact same amount of time. The only thing that changed was where you decided to park it.
And honestly, the best part is how easy this is to fix. You might be thinking, opening a new bank account sounds like a huge hassle, but I promise you, it is surprisingly quick and painless. Let's just walk through the 5 simple steps right now.
First things first, let's just get your stuff together. And it's all the standard info you'd expect. Probably stuff you have right in your wallet or purse. You'll need an ID, like a driver's license, your social security number, and the routing and account number for the bank account you're going to move the money from. Having this ready makes the whole process take like 10 minutes.
Okay, here's the entire playbook from start to finish. Step 1, shop around online. A quick search for best high-yield savings accounts will show you all the top rates. Step 2, you've already gathered your documents. Step 3 is choosing an account type. We'll touch on that in a sec. 4, you fill out the application, which is usually online. And 5, you make that first deposit to get it all started. That's it.
So for that third step, you'll pick between an individual or a joint account. It's pretty straightforward. An individual account is just for you. A joint account is for you and someone else, like a spouse or a partner. The one big advantage of a joint account, though, is that it doubles your FDIC insurance. That's the federal protection on your money, from $250,000 all the way up to $500,000.
Now, what if you apply and, for whatever reason, maybe a bumpy banking history, you get denied? Hey, don't sweat it, and definitely don't give up. Many banks offer something called a second chance account. They're specifically designed to be more accessible and help people get back on track.
So, opening the account, that is a fantastic first step. Seriously, pat yourself on the back. But it's really just the beginning. To make this change really powerful, you need a smart game plan for what comes next.
Here are 4 super simple tips to build a great plan. 1. Give your money a job. Is it for a down payment? A vacation? Get specific. 2. Give it a deadline. When do you need the money by? 3. You could even open up different accounts for different goals to keep things organized. And 4, this is the most powerful one. Put it on autopilot. Set up automatic transfers every payday, so you're saving without even having to think about it.
So, we'll end on this thought. Your money could be working for you, around the clock, defending its own value, building your future. So, why would you let it just sleep while that invisible thief, inflation, chips away at it? The choice is simple, and it's all yours.